As of June 30th, 2025, downtown Miami condo inventory is up 52% since June 2024. I had initially projected just 5% resale rate of pre-construction units, but now, with new data in hand, it's clear that number is well underestimating the trend. Today, I'll explain why this shift matters for your buying or selling strategy over the next several years. You probably remember my video from this time last year, where we looked at nearly a half-mile radius in central downtown Miami, where there is a high concentration of nearly 3,000 pre-construction units.
Waldorf Astoria, 360 units. Ocon Towers, 385 units. 600 WMC, 606 units.
At that time, there were only 314 condo listings on the MLS. Fast forward to today, and that number has surged to 456, a 45% increase in just 12 months. I'm Brian Oyola of One International World. In this update, I'm taking you through the real story behind the inventory surge, how pre-construction resale is changing dynamics, the latest sales and pricing data and what it reveals, forecasted market impacts, practical takeaways for investors, buyers, and sellers moving forward. As of June 30th, 2025, there are 456 active listings within the same half-mile radius, compared to 314 1 year ago. That's not linear growth, that's exponential. But here's a key point. The Aston Martin residences located just outside that radius now has 25% of its units listed for sale. And that's not included in our 456 count. If it was, the increase would be even more dramatic. Let's talk about Natiivo downtown, which has the Gale Miami Hotel and Residences for its first 23 floors. Natiivo has 412 condo residences, and Gale has 140 condo hotel units. This building has 552 condo units total, and 93 are currently listed, which means roughly 17% of the building is on the market within months of closing. Several of these seem to be developer units. What's more eye-opening is that Aston Martin hit 25% resale within a year, while Natiivo is at about 17%, indicating higher willingness to sell early in the cycle. This market behavior reinforces that my original 5% resale assumption was overly conservative. Now let's project forward. With around 3,000 new units expected in downtown Miami between 2026 and 2029, a resale rate of 15 to 20%, which I believe is plausible, could add 400 to 600 new resale units over that time frame. That's a potentially game-changing surge in supply. Let's ground this in actual performance. Closed sales for the first half of each year: 2022, 527, 2023, 265, 2024, 216, 2025, 190. That's a 12% slide from 2024 to 2025, and nearly a 64% decline since 2022. Meanwhile, the average price per square foot in downtown rose from $650 to $680, a 4.6% from the first half of 2024 to the first half of 2025. And inventory has climbed steeply. Currently, combined zip codes 33131, 33132, and 33130 show around 20 months of inventory. By contrast, a balanced market typically sits at 4 to 6 months, meaning we are sitting in extensive oversupply mode. So what's driving this? It's a twofold dynamic: resale units flooding the market and price increases that may be tempering down buyer interest. Add macroeconomic pressure, higher rates, trade tensions, global unrest, and we have a fragile environment. What does this mean for the market moving forward? Supply surge. 400 to 600 new resale units will enter the downtown market over the next 3 to 4 years. Demand softening. Sales volumes have dropped every year since 2022. Rate and global risk. Buyers are cautious, waiting for clarity. Price anchoring. Resale sellers seeing similar comps still list at 2024 prices, deterring buyers. All of these together signal that buyers may soon hold leverage, thanks to increased selection and higher negotiating power. So the big question, will prices fall and by how much? A price correction seems likely, but how deep? Could it be a mild 5% drop, something more significant like 10%, or even a sharper 20% retracement? Here's what it depends on. Absorption rate. Can demand return fast enough to counter extra supply? Rate, macro recovery. Will interest rates fall? Tariffs ease, geopolitical tensions calm, boosting buyer confidence. Resale behavior. Will sellers adjust prices or stick to outdated comps? Inventory levels. Sustained supply above 18 months intensifies downward pressure. In simple terms, if macro conditions normalize and buyers re-enter quickly, we may see a mild dip or even stabilization. But if conditions deteriorate or sellers hold firm on pricing, they risk a deeper correction in a saturated marketplace. For investors, buyers, track resale listings. Watch how many post-close listings hit each tower. Monitor months of inventory quarterly. Are absorption rates trending down? Compare price per square foot trends. Use this as your baseline, not list or median pricing. For sellers, set realistic expectations. The 2022 market is not back yet. Be flexible. Expect longer days on market with price sensitivity returning. Use tactical offers. A small concession now could save months of listing time. For agents and advisors, leverage knowledge. This is both your warning sign and your selling advantage, depending on how you present it. Key takeaways. Inventory up 45% locally, 52% overall. Natiivo, Gale Hotel and Residences has 70% of units listed. Pre-construction resale could add 400 to 600 listings over the next 3 to 4 years. Sales have dropped. Price per square foot is slightly up, but supply is significant. A price correction now hinges on demand and macroeconomic responses. If you're navigating this market, data is your edge. I'll continue tracking resale trends, absorption rates, and pricing. Every week, I break down what others overlook in Miami real estate, so hit subscribe to stay one step ahead.